Hello everyone. Today we are talking about tariffs. First, we'll look at some examples from the past to understand why America has put tariffs in place before and how that affected other countries and the global economy. This can help us get a better idea of what might happen if new tariffs are introduced now. Then, we'll go over three possible scenarios that JP Morgan has identified about how tariffs could play around this time. In 1789, the United States imposed a 5% tariff on all imported goods. Why? The government needed money and wanted to protect American producers from foreign competition, especially the British. Back then, tariffs were the main source of income for the US, making up as much as 95% of federal revenue. Alexander Hamilton believed tariffs were good for American businesses in the long run. He wanted the US to become less dependent on other countries, especially for manufacturing. After the War of 1812, the US raised tariffs to 25% on items like cotton, wool, leather, and iron. The goal was to protect growing American industries, especially textiles, from cheaper British imports. In 1890, the McKinley Tariff took things even further, raising average duties to nearly 50%. The goal was to protect American workers and businesses, but it resulted with higher prices for everyday goods like clothes and groceries. Some historians even link it to the economic recession of 1893. Then came the Smoot-Hawley Tariff Act of 1930. It raised tariffs on over 20,000 imported items. The average rate jumped from 40% to 47%. The intention was to protect American farmers and manufacturers during the Great Depression. But it backfired. Over 1,000 economists warned against it. Other countries like Canada and France hit back with their own tariffs. Global trade dropped by 66%, US exports fell by 61%, and imports by 66%. It made the depression worse, leading to more bank failures, especially in farming regions. It also pushed America towards isolation in trade policy. In 1934, President Franklin D. Roosevelt responded by signing the Reciprocal Trade Agreements Act. This allowed the US to lower tariffs through deal with other countries, a big step towards global trade cooperation. From all past actions of imposing tariffs, we can conclude that tariffs have always been used to protect American industries from foreign competition. They reduce demand for foreign goods by making them more expensive. But they also come with side effects like higher prices, trade wars, and economic downturns. Now, let's talk about what could happen next. JP Morgan has laid out three possible scenarios for tariffs. These are just possibilities, but they help us understand the range of outcomes and what we might need to prepare for. In the first scenario, JP Morgan is assuming that the US doesn't go all in on tariffs. Instead, it makes some trade deals or compromises with other countries. On top of that, businesses might find ways to work around the tariffs, for example, by changing where they get their goods from. Because of all this, the real impact of the tariffs, also known as the effective tariff rate, ends up being lower than the official numbers. JP Morgan estimates it would land somewhere between 10 and 20%. Now, even though that's not the worst case scenario, it would still hurt the US economy. It is likely to see slower economic growth, which means the economy isn't expanding as fast. Unemployment could rise as businesses try to cut costs, and prices for goods might go up, which adds to inflation. In this case, the economy might avoid falling into a full recession, but just barely. It would be a close call. For investors, this kind of situation could lead to a lot of market ups and downs, what we call volatility. Stock prices might swing more than usual as investors react to news and changing expectations. This kind of environment can be risky, but it also creates chances. If you know how to take advantage of the price swings, for example, by buying when prices drop and selling when they rise, there could be some good opportunities to grow your portfolio. Now, let's talk about scenario 2, which JP Morgan sees as the worst case scenario for markets. In this case, all of the proposed tariffs, including the ones announced on April 9, are fully put into place and actually stay in effect. On top of that, other countries respond by putting their own tariffs on US goods, though not as strongly. That's what's called partial retaliation. If this happens, JP Morgan expects the effective tariff rate in the US to jump about 20%. That's a pretty big deal. Higher tariffs would likely lead to more expensive goods, which means consumers might start cutting back on spending. Businesses could also lose confidence, delay new projects or investments, and even start laying people off. Altogether, this would hurt the economy badly, not just in the US, but globally too. In this scenario, a recession in both the US and the global economy becomes very likely. So, what does this mean for investors? Markets would take a hit. Stocks around the world could fall sharply, which could tumble to double digit drops. Investors would likely rush to safer assets, and we would expect central banks like the Federal Reserve in the US and the European Central Bank to step in by cutting interest rates to try to calm things down. Bond yields would fall, and the US dollar could weaken even more. In a situation like this, investors would be better off going on the defensive. That means focusing more on safer investments like bonds and gold. Gold, in particular, has been performing well. It's already up 27% this year. During times of uncertainty or geopolitical tension, gold tends to hold its value and even go up. Central banks have also been buying more gold and reducing their exposure to US treasuries, which could give gold even more room to grow in value. So, overall, this scenario paints a pretty rough picture for the markets and the economy, but it also highlights the importance of having a well diversified portfolio that includes defensive assets like bonds and gold. Now, let's look at the most optimistic scenario, scenario 3. This is where things take a positive turn. In this case, the US and its trade partners find a way to ease tensions and either delay the tariffs or make sure they are not as harsh as people feared. If that happens, market confidence would likely bounce back and the US effective tariff rate could drop below 10%. JP Morgan says this is the least likely outcome, but it's also the most promising for investors. In fact, this scenario has the biggest potential for gains in the stock market. Global stocks could go up more than 20%. That's because if the threat of tariffs fades, businesses and consumers would feel more confident and investors would move their money back into riskier assets like stocks. Even in this positive case, central banks like the Fed might still cut interest rates a couple of times just to support continued growth. Bond yields, which often move opposite to bond prices, would likely stay within a steady range, and the US dollar might recover some of the losses it had recently. The biggest winners in this scenario would be the areas of the market that got hit hardest during the trade tensions, things like big tech companies, small cap stocks, and the energy sector. As those risks go away, investors would be more comfortable putting money back into those parts of the market. So, while this outcome may not be the most likely, it shows how much potential there is for a market rebound if trade tensions ease up and policies turn out to be less damaging than expected. Thank you for watching the video. I hope the information was helpful. See you on the next video.